Hey guys, welcome to Market Mondays. Hopefully you guys had a great Thanksgiving. Today we're gonna give you guys a quick breakdown on everything that happened last week and what's expected to happen this upcoming weeks. So before I get right into it, I'm gonna do a quick dad joke. Dad joke today is, what kind of Christmas carol do they sing at a mental hospital? At a mental hospital. Do you hear what I hear? Get it? Pew pew. All right, so getting right into it, we finally got the information on the housing price index. Now, this information tells us how appreciation has been doing basically in the last month. So, with that in mind, for the most part, we can see that home price appreciation has slowed down by a lot. You can see, the month over month is, barely 0.2%. And really, right now, the average for the year over year, basically over the last 12 months, is about 1.3%. So, for the most part, appreciation has slowed down a lot. It doesn't mean there isn't appreciation, it just means it's slowed down by a lot. Now, keep in mind, a lot of the home buyers or homeowners that we've seen today, a majority of them have bought between 2019 to 2021, right? And that's when rates were quite a bit lower, and a lot of people started buying homes then, especially those who couldn't afford to buy a home before were able to buy a house. So I wanted to kind of share some information I found in regards to how the home price index has gone with over the last basically since 2018. So if we're looking at this chart over on the, in this annual change number, you can see that home price appreciation was pretty much on a within the national average of 3 to 5% up until 2021. So 2021 shows what happened in the last 12 months. So keep in mind, that's when rates were super low and people started getting into the market and finally caught wind that rates were really low. So, and then, a lot of people got paid for unemployment, all that stuff. So we did see well over above average, like basically 12% on appreciation in 2021. And then 2022 went up to about almost 16%. Now, keep in mind, this is a lot of appreciation for one single house. So, for example, if a lot of people, just to give you an idea, in order these 3 years combined make up what you made in 2021. That's a lot, 3 to 5% a year. It takes about 2 or 3 years to get 11% on the home appreciation. If you bought a house in 2020, you would have, or even 2019, you would have benefited from this almost 12% appreciation. So that's a lot of appreciation that we saw. And that's one of the reasons why home prices have gone so high and become home price and just homes just become really unaffordable because of this amount of appreciation. Keep in mind, this had to do with a supply chain shortage. This had to do with, rates being lower, allowing more people to buy a home. So there was a lot of demand. There was a lot of people entering the market to buy a house, which caused home prices to go up. When you have too much demand but not enough supply, this is what happens. And then in like about near the end of 2022 is when rates shot up to about 6, 7, 8%, stay that way throughout 2023, and that's why we're seeing lower numbers now and more into the normal range of 3 to 5%. So the reason why home prices are the way they are is because what it was in 2021 and 2022, they shot up and they've been kind of going down. It going down this much and going down even lower is probably a good thing to bring down the average. If we average the last 5 years of home appreciation, the number was about 9%. So if you kind of gives you an idea that if you bought a house for $400,000 in about 2019, so you bought a house in 2019, you bought it for $400,000 over the last 5 years, that house is now worth $600,000. Oh, about 55% in appreciation on the house you bought in 2019. So with it coming down the way it has, and there's a lot of people suffering from buying in 2021 and 22, is because home appreciation was so high and then it slowed down quite a bit, almost to a halt. And right now, 2025 is looking about a little over 1% appreciation, right? Now rates are significantly about 1 to 2% lower than where it was in 2023 and 2024, but still, it's slowed down home prices appreciation by quite a bit. So yeah, if you bought in 2023 and 22, there's a very strong chance those clients may not have enough equity to sell the house quite yet. they may have to wait a little bit longer just because they bought at the height, right? Ideally, this is where 2019, 2022, or even 2018 were the times to buy. Now, what are we looking at moving forward? So 2024, 2025 is coming to an end. We're seeing about 1 to 2% appreciation, which in the bigger view of things, it's actually a really good thing to slow down home prices as much as we can. That way, wages can catch up. Now, the next thing that we're considering is that mortgage rates are expected to continue to get better. As mortgage rates continue to get better, every 1% lower it gets, 5 million more people are eligible to buy. So over the last year and a half, 18 months, I would say mortgage rates really gone from like the 7.5% down to now the low sixes to high fives. So as we continue, maybe in the next year, 2026, we see mortgage rates hit maybe the 5.5, low fives. We could see another 5 million people into the market, which would cause home appreciation to go up higher than probably the 1.3% that we will see in 2025. So overall, the average coming down over the last 5 years is really good just because we've saw just unsustainable numbers. So that's one of the things that we want to consider when we're looking into the housing market moving forward. You don't, buying in 2022 and 21 is basically the idea of buying at the height of it. So those people who have bought in between 2022 and 2023 really need to probably keep the house for about 5 to 6 years in order to even make money on the house. It's really hard these days, especially if you bought in the West Coast, to buy a house in that range and be able to rent it out. Because the other tough thing is that, yes, your home price is higher, but mortgage rate may not be as high, but even with the price at where it's at, it's hard to rent that out for the mortgage to make up for the mortgage payment that you're trying to pay. So that's what's tough about everyone that bought between 2021 and 2023, as far as where they're at with their home equity. They may not have a lot. Now, if you bought prior to 2020 or even in 2020, you're probably sitting nice and pretty, especially if you still have that house. So tons of equity. A lot of those people most likely refinance in 2020 and 21 for a much better mortgage rate. So it's hard to let go of that mortgage rate. It really is, especially if you want to refinance and get some equity out. So I just wanted to share that information. So the next thing I wanted to share with you guys has to do with the December 16th reports. So this week we're going to get some of the normal jobs reports that we're expected to get in the first week of the month. So we'll get what's called JOLTS, and we get something called ADP employment data. JOLTS tells us how the job openings have been. Basically, there's been job opening postings, things like that. And then ADP is a way to tell us how wages and weekly earnings have been. So keep in mind, a lot of these employment data, labor market data are delayed because we don't have the October report and we don't know what November looks like. So on December 16th, what we're going to get is the report for October that was supposed to be released in November to tell us how October went. Keep in mind, there's a lot of stuff that happened in October. For example, government shutdown. We have a bunch of furloughs, and even Amazon employees got laid off, and a bunch of other companies have laid off a bunch of people. So in December 16th, we're supposed to get that report. And then about a week later, we may get the report for November we're supposed to be released this week. So we're not going to get the unemployment rate data like we normally do this week, but December 16th could be a really big, important piece, especially if the unemployment rate from September is at 4.44, and we're so close to getting to 4.5 when it's just a slight bump up. So we might be seeing 4.5 in December 16th unemployment rate data, and that could show that. And if that shows, we could see mortgage rates improve on December 16th, and that's probably a good milestone marker this week. There is probably going to be some jobs data that's going to have a big impact on mortgage rates, but December 16th is probably going to be a big milestone marker. The other thing is that the Fed. Now, the Fed is intended to potentially raise the Fed funds rate, lower the Fed funds rate next week by maybe 0.25%. There's a 70% chance based on the last update. So they went from 30% chance of changing the Fed funds rate to 70% now. So they're seeing enough of the information to see that the Fed rate needs to go down, which I do definitely agree with that. And there will be a new Fed president. It's going to be announced soon. We don't know who it is, but it will be announced. And then now we want to kind of take a look how the charts look for mortgage rates. So this is how mortgage rates have pretty much trended over the last, basically since May. May, it's improved a lot, right? So right now we're seeing these numbers here over the last 2 weeks since the government shutdown ended. We saw improvements in mortgage rates over the last basically entire month of November. Basically, we're back down to roughly where the end of October looked. So there's a slight bump here, but I think we're back down to where November looked around here. Keep in mind the orange line is government rates, which applies to VA and FHA. The blue line is conventional. So we're essentially back down to where we were in October, which is a good spot. And then in the next 2 weeks, we're going to get some more improvements in the numbers and reports, get caught up. But I do want to remind you guys, keep in mind, we might be in another government shutdown in February. So make sure you're planning accordingly with your finances as best you can. And that's about all I got for you guys this week. Otherwise, nuke out.